Managing a massive corporate group involves navigating a labyrinth of operations spanning dozens of countries, multiple shifting currencies, and completely different tax jurisdictions. Without a rigid digital blueprint to capture this activity, financial data becomes unmoored. It is legally non-compliant for local governments and managerially useless for executives trying to understand the bottom line. SAP S/4HANA solves this through a strict hierarchy, beginning at the highest level, the client. This is an independent universe containing all group-level master data and tables. There is a firm technical limitation here. Within that client universe, the system will not allow you to post a single financial transaction until you define a mandatory foundational unit beneath it. This diagram shows the structure. Directly beneath the overarching client, the system branches into multiple independent legal entities. These entities are company codes. The company code is the most important organizational unit in financial accounting, acting as the minimum structure necessary to represent a fully independent, legally compliant accounting entity. To build one of these entities, administrators follow a specific customizing path using transaction code OX02. Instead of building from scratch, administrators copy a pre-existing country template. The new code inherits the tax structures and legal formatting required for that specific nation. This screen shows the essential identity fields. You assign a unique 4-digit alphanumeric key to identify all postings and define local parameters, including the legal name, city, country, local currency, and reporting language. Once the local identity is established, administrators enter global parameters using transaction code OBY6. Here, the overarching group ID is assigned. By populating the company field, seen here as GE01, the localized entity is officially mapped back into the broader corporate group. These configuration steps ensure every financial posting managed within this code is permanently bound to the local currency and legal requirements of its home country. While the company code satisfies tax authorities, executives have different needs. They require a way to evaluate the success of specific internal divisions, regardless of location. This is the role of the profit center. This optional unit evaluates independent areas of the business responsible for generating their own distinct costs and revenues. There is also the segment. This unit is specifically required for external segment reporting to comply with accounting principles like US GAAP or IFRS 8. Businesses can also define business areas for cross-company operations like consulting, or deploy functional areas to track exactly where overhead costs are incurred. This creates a clear division of labor. The company code satisfies external mandates, while these optional organizational units allow executives to track operational performance and ROI. Corporate groups must also allocate costs across distinct legal entities located in different countries. The system achieves this through the most critical element in management accounting, the controlling area. This diagram illustrates the relationship. A single controlling area acts as a centralized management umbrella directly above multiple company codes. Crucially, every assigned company code must operate under the exact same chart of accounts. This acts as the mandatory bridge between them. This cross-company assignment is executed in the system using transaction code OX19. This table shows the result of that configuration. Multiple localized codes, including 1010, 1710, and GR01, are now clustered under a single central authority, controlling area A000. Assigning multiple company codes to a single controlling area bridges geographical silos. This enables seamless cost accounting across every assigned entity in the entire enterprise. When we map the complete digital architecture, we can track exactly what happens when a transaction enters the system. Data hits the company code and instantly splits. One stream flows toward legal tax reporting, and the other flows into the controlling area for management. Because of this structural setup, a single data entry performs double duty automatically. This eliminates the need for manual reconciliation between different departments. For a multinational corporation, this degree of integration ultimately replaces fragmented data mapping with a seamless, automated workflow. In SAP S/4HANA, these organizational units function as interconnected architectural gears. They align fragmented global operations into a single, reconciled record of financial activity.